Treasury bill, of course, is an instrument of money market because a treasury bill, which is used by the government of India, issued by Reserve Bank of India on behalf of the government of India for helping the government of India to meet their funds requirements. So, treasury bill can have a duration of 14 days or 91 days or 182 days or 364 days. So in all the cases, we can see that the tenure of a treasury bill is less than 1 year, and therefore treasury bill, of course, is the instrument of money market. Now these treasury bills, friends, remember, are always issued at a discount. So a treasury bill will not have a coupon rate. It is issued at a discount, and the treasury bills are always issued in the denomination of 25,000 or multiples thereof. So a treasury will always be issued. The minimum denomination of a treasury bill is 25,000 or multiples thereof. They are issued at a discount. The treasury bills are repaid at par on the expiry of the tenure by the Reserve Bank of India. So they are issued at a discount and they are redeemed at the face value. So difference between the face value and the issue price becomes the return of the subscriber. Now, what are the types of fixed income securities and what are the types of different fixed income securities or bonds? So let us understand it. Number one, we have floating rate bond, and we all understand it very easily. So floating rate bond would simply mean that the rate of interest or the coupon rate on these bonds is going to be linked with an index, and the rate of interest can vary depending on the movement in the index. Fixed rate of bond, that means the coupon rate is fixed in case of these bonds. Zero coupon bond or deep discount bonds, remember same thing that we have discussed in the earlier context. Convertible bonds or non-convertible bonds. So the convertible bonds are the ones which get converted into equity as per the terms incorporated in the indenture at the time of the issue of the bond. So these bonds can be optionally convertible, or they can be compulsorily convertible, or whatever. So a convertible bond would mean that it would get converted into equity. Callable bond and puttable bond, and these are the types of bonds that can be issued, and we have discussed as to what is a callable bond and puttable bond already. Now the question is, can a bond have both these features? Is it possible? We understand a bond can be callable, we understand a bond can be puttable. Is it possible that a bond is callable also and puttable also? And the answer, of course, is yes. And why it is yes? Because what is bond? Bond is nothing but a contract. And remember, if it is a contract, then based on the mutually agreed terms, subject to the provisions of the Contract Act, bond can also be issued where it is not only callable but it is also puttable. That means the bond has both the features. It has the callable call option, and it also has the put option. Then you have a perpetual bond. So what is perpetual bond? Perpetual bond are the only bonds that does not have a specified maturity. So these are issued for perpetuity. And I'm sure a question may come that how does it work if they are issued for perpetuity? So will they really remain for eternity? And the answer is perpetual bond will not have a tenure, and that is why they are referred as perpetuity. But the perpetual bond will always have the call option and the put option. So after a certain period, the buyer will have the option to exercise the put option, or the issuer will have the option to exercise the call option. And in under what circumstances these options can be exercised will be part of the indenture on the perpetual bond. So that is your perpetual bond. And the question is, are these perpetual bonds issued in real life also? And the answer, of course, is yes. Incidentally, I was taking this session some time back, and incidentally, it so happened that in the morning I opened the Economic Times and I saw a big ad from State Bank of India issuing perpetual bond. So these, of course, are issued. Tax-free bonds, as the name suggests, if you make investment in these bonds, then you are exempt from. Then the investment that you make in these bonds is not taxable in your case. And why will somebody be allowed to issue the tax-free bonds? So remember, the tax-free bonds can be issued only by a government entity or government enterprise, and generally it is in the context of an entity which is in the business of infrastructure building. So when a company, when a government entity is in the business of infrastructure building, and they have the facility of offering the bonds as tax-free bonds. And the idea is to give a kind of an incentive to the subscriber to subscribe to these bonds, because the tax exemption becomes a big carrot for some people to subscribe for these bonds. They are infrastructure bonds, so that is the reason why the government needs to incentivize issuance of infrastructure bonds with tax-free facility. Junk bonds, as the name suggests, junk bonds are the bonds which are extremely risky, and where there is no certainty with regard to servicing of that bond, and also with regard to repayment of that bond. The credit rating of an issuer is very weak, and when the credit rating of an issuer is very weak, then the bonds issued by such issuer are referred as junk bond. And a question can come to your mind as to why should somebody subscribe for junk bonds. Somebody would subscribe for the junk bonds because the issuer is going to offer a relatively high rate of interest on these junk bonds. And there are people in the market who think that they know everything and whose risk appetite is very high. So they don't mind taking a risk for earning bigger rate of interest, and that is your junk bond. Then you got an income bond. Now, income bond, interestingly, friends, when you hear the term income bond, it sounds that this bond is going to give you income. Remember, all the bonds are going to give you income in any case. But income bond, on the contrary, will give you interest only if they have income, and that is why they are known as income bond. They will pay it coupon only if they have income, and this is known to the subscriber well in advance, so that the subscriber knows it. And obviously, if somebody has to issue such kind of a bond, then some incentive has to be given, and that incentive is going to be in the form of higher rate of interest. Subordinated bonds. Subordinated bonds will simply mean that the terms of this bond are subordinated to another bond which has been issued already. Let's say, for example, a company has issued secured bonds, and where the company has offered security against the issuance of these bonds. Now the company needs some more money, and therefore the company comes out with second series of the bond. And when the company comes out with the second series of bond, it again offers security on its assets. The only thing is, security offered in case of the second series of the bond is subordinated. That means the assets are first to be offered as a security to the first series of the bond. After the first series of bonds obligations have been taken care of, then the remaining assets will be used for the second series of the bond, and that is referred as subordinated bonds. Bearer bonds, we all know, it simply means that bearer bond will not have the name of the owner on these bonds. So these bonds belong to the person who is carrying them. So these bonds are easily transferable. So those are known as bearer bond. Then you got a Yankee bond. So what is Yankee bond? Yankee bonds are the bonds issued by banks, companies, and the financial institutions from outside America in America. So a company or a bank or financial institution, when he is raising money through bonds in US, and these bonds are going to be listed in US, and these bonds are denominated in US dollar. Now such bonds are referred as Yankee bond. And then of course you got an inflation linked bond, which are, as you can understand, in case of floating rate bonds, the rate may be linked with the interest. So if the interest goes up, if the inflation goes up, the rate of interest on these bonds also go up, and that is why they are known as floating rate bonds. And then you got asset-backed securities, which I am sure you will know that a lot of these home loan companies, credit card companies, car finance companies, now what they do, for increasing their lendable funds, what they do, whatever assets that they have built in the past by lending home loans or car loans or personal loans or credit card loans, what they do, they securitize their receivables. They securitize their receivables and sell it to somebody. And for this purpose, they issue the securities. Such securities which are backed by these receivables are referred as asset-backed securities. So friends, these are the different types of financial these are the different types of fixed income securities or bonds which are issued. And please remember again, what I'm discussing with you are the broad terms which are available. So if you go deeper into it, which all of you should do, and so as to get even better handle, you will come across there may be some more categories of bonds which are there in the debt market or fixed income securities market or in bond market. So with this, I move to the next slide, and in case if you have any question on this, you can please ask me.